Okay, so let's take a look at a variance example here. Let's assume that we work for a company, and this company makes PCs that has the following standards for production. These standards are basically what we're going to budget with. Okay, so for direct materials, each PC requires one processor that costs us $200, and it requires 2 additional components that cost us $25 a piece. We have a direct labor cost. It takes 15 minutes. We're budgeting for a quarter of an hour at $8 per hour for labor. Now, let's assume that during the month, 3,000 PCs are produced and the following inputs are used. Okay, we purchased 3,500 processors at a total cost of $735,000. We used 3,050 of them. Okay, we purchased 8,000 components at a total cost of $192,000. We used 6,000 of those. Okay, direct labor, we had 800 hours worked at $7.50 per hour. So again, less than what we budgeted. That's okay. Now, how do we come up with these actual numbers here versus our budgeted numbers? Well, we take that $735,000 divided by the 3,500 that we purchased. That tells us we actually spent $210 per processor on it. Same thing with our components. $192,000 total. We bought 8,000 of them, so we spent $24 per component on it. Okay, so here we have our purchase. Okay, this is what actually happened. Okay, and this is what we had budgeted for. Okay, 3,000 units produced times one component or one processor per unit times $200 per processor. We budgeted for $600,000 cost for processors. Okay. Same thing with components. 3,000 were used. We budgeted for 2. We budgeted those to be $25 a piece. That's $150,000 that we budgeted for. Okay. And then direct labor, finally, you'll see those match up. Okay. So here you will see the total. What we actually spent, $933,000. What we budgeted to spend was $756,000. So a little under $180,000, or a little under $200,000, about $183,000 a piece, or not, excuse me, not a piece, but $183,000 variance in our budget to actual, right? So we were over what we budgeted for. Okay. So the direct labor variance analysis. This is going to be the first of one of the five different variance analyses that we're going to do. So if the actual amount of direct labor is different than the budgeted amount of direct labor, there are 3 reasons why this could be happening. The first is that the wage rate per hour was different than what we stated. So we could see that in that last example, right? We budgeted for 8. The actual was $7.50 per hour, right? Or it could be that the number of hours used was different than the standard, right? So we budgeted for 1,200, but the actual hours were 800, okay? Or it could be a combination of both of these, right? So either the wage rate, the wage rate and the hours used different than the standard, okay? So to analyze these explanations, we're going to calculate what we call a direct labor price variance. That's the DLPV. And a direct labor usage variance, the DLUV. We will start with the DLPV. Okay, what this tells us is that, what it indicates, I shouldn't tell us, what it indicates, what we can kind of assume is that the difference in labor cost is due to a change in the average wage rate. Okay, we calculate it the following way. These are going to be extremely important formulas for you to know for your exam. Okay, so I would write these down for sure. So you take your actual price per hour, and you reduce that by your standard price per hour, and then you multiply that times the actual number of hours worked. Okay, so if the actual price is greater than the standard price per hour, then your direct labor price variance is going to be a positive number. This indicates an unfavorable variance. Now, here's the thing. Do not associate positive and negative with good or bad. Do not associate unfavorable or favorable with good or bad. Okay? we really have to get down to the nitty-gritty of why this is happening to determine whether or not it's a good or a bad thing, right? So in this case, right, when we get to the example, we'll talk about this. But let's say that the actual price is actually less than the standard price per hour, then your DLPV is a negative number, and this indicates a favorable variance. It's favorable for us, right, because we paid less than what we thought we were going to pay. However, is that always a good thing? Not necessarily, because if you look at what we did, we actually paid our laborers 50 cents an hour less than what we said we were going to. Do we think that makes for happy laborers? Do we think that those people are going to continue to work for us if we pay them less than what we think we're going to pay them? Probably not. So favorable versus unfavorable doesn't mean good or bad. It just means, was it favorable in our favor or not? Okay. So here you can see at this example, we paid our actual rate was $7.50 an hour. What we budgeted for was $8 an hour, and we used $800, or we used 800 hours, so we had a $400 favorable variance, right? Favorable for us because we paid less than what we said we were going to pay. Here's an important note. We do not show the $400 here as a negative number. You notice this would be a negative number, right? It's negative 0.5 times 800 would be negative 400. But we know that the negative number is favorable, so we just denote it as favorable. Okay. So if you have any questions about this, please give me please get a hold of me, contact me somehow, email me, whatever the case is, and I will try to answer it for you.